Many of us keep money in a CD or money market account, a cash reserve that we keep safe from investment risk. And if we never need any of this money, we intend to leave it to our family, our college, our church, or our favorite charity. However, this money is earning less than the rate of inflation, so it's actually losing value every year. What's more, the little interest we do earn on this money is all taxable, which further diminishes its value. But now there's an alternative to keeping this money in a bank account, an alternative that can earn a higher rate of interest without taxation. It allows you to withdraw up to double your account value to pay for assisted living or nursing care tax-free, and it can increase your bequest by as much as 200%. This alternative is made possible by Internal Revenue Code Sections 101 and 7702. These provisions of the tax code enable you to convert a taxable reserve fund into a tax-exempt insurance contract that can guarantee as much as double your deposit, depending on your age and health. Additionally, you have the option to withdraw money from this tax-exempt insurance benefit if you need to pay for home nursing or assisted living care, if you're diagnosed with a critical illness like cancer, stroke, or heart disease, or if you are given less than a year or two to live. If you are one of the fortunate few who never need the money, any unused tax-exempt benefit will transfer directly to your family, tax-free. For example, Jerry and Kathy were in their mid-60s when they transferred $100,000 from a certificate of deposit into two separate cash value insurance contracts with a guaranteed minimum tax-exempt benefit of $84,000 each. These contracts included special provisions to withdraw their money without taxation for a critical or terminal illness and for home nursing or assisted living care. When Jerry was diagnosed with cancer in 2002 and given less than a year to live, he withdrew $42,000 tax-free to pay for expenses that were not covered by either Medicare or his supplemental health insurance. He also withdrew $42,000 more, also tax-free, to take a first-class 6-week world cruise with Kathy before the cancer ended his life. 4 years later, in 2006, Kathy had a stroke that left her in a wheelchair and required home nursing care and assistance with bathing and dressing, as well as household chores like cooking and cleaning. Her cash value insurance contract allowed her to withdraw the money she needed to pay for all of these expenses until she passed on 14 months later. Kathy then left the rest of the money, tax-free, evenly divided between her 8 grandchildren. In this example, Jerry and Kathy converted a $100,000 taxable savings account into $168,000 of guaranteed tax-free cash benefits as the money was needed. But if that money had never been needed, the entire $168,000 would have passed tax-free to their grandchildren. So, ask yourself this: do you want to keep paying taxes on your savings every year, or pay taxes on any money you withdraw from your investments if you ever need that money to pay for home nursing, assisted living care, or any other expenses not covered by Medicare? Or would you rather earn interest and withdraw money from your savings if you need to, or pass it on to your family if you don't, without taxation? It's really just that simple. So, doesn't it make sense to keep that money in a tax-exempt cash value insurance contract instead of a taxable investment or savings account? Talk to the financial professional who shared this plan with you. Schedule a consultation to explore how this strategy can enhance your financial security and pave the way for a prosperous future.